Hey everyone, welcome back to Corporate Decoder, where we decode the language of money and help you understand what's really going on behind those big corporate numbers. Today we're diving into General Enterprise Ventures Inc., or GEVI as they call themselves. They're in the business of helping us all avoid wildfires with some kind of fire retardant spray. They recently filed a report, and let's just say there are some sparks flying in their financials. Before we jump in, make sure you're subscribed because we're uncovering the real stories behind these filings. And hey, if you want to keep this conversation going after the video, join our Discord community linked in the description below. We love hearing your thoughts. So GEVI wants to sell more of its stock to the public. They're aiming to sell 1.5 million shares of their common stock. Think of it like this: they're offering pieces of the company to anyone who wants to buy them. The price they're asking for each piece is between $7 and $9.10, and they seem to be aiming for the middle, around 8 share. Now this is happening at the same time as something called a reverse stock split. Imagine taking all the shares they have right now and magically consolidating them. For every 6 shares that were around before, there's now just 1 new share. They did this to their preferred stock too. This is often done to get the stock price up to a level that's acceptable for bigger stock exchanges like the NYSE American. Right now they have about 11 million shares of common stock out there. After this offering, depending on the exact price and if the buyers want extra shares, they could have over 12 million shares. This is important because more shares floating around can sometimes make each individual share worth a little less if the company's value doesn't magically go up at the same rate. GEVI says they're all about being green and sustainable in the fight against fire. Their main product is called Citrotech, and it's made from things like corn and fruit. They say it's safe for people and the environment, which is a big deal because they point out that a lot of other fire retardants use toxic metals. Their target customers are homeowners, developers, and fire departments, mostly in the western states, where wildfires are a big concern. They even have a system that can spray this stuff around properties to create a fire barrier. Interestingly, GEVI's stock is currently traded on a less regulated market called the OTC ID. They're trying to get listed on a bigger exchange, the NYSE American. But here's the catch: this whole stock sale is dependent on getting that listing approved. If they don't get approved, they won't sell any of these new shares. It's like saying we'll only have this big party if we get invited to the VIP room. Now let's talk about dilution. It's a term that makes investors pause. Basically, when a company sells more shares, it means your ownership stake in the company gets a little smaller for the same amount of money you put in. They're admitting right up front that if you buy shares in this offering, your share of the company's actual value on paper will be worth less than what you paid. It's like buying a pizza and then having to share with even more people so your slice gets smaller. Let's peek at their numbers. For the first 3 months of 2025, they had revenue close to $970,000. That's good. That's more than double compared to the same time last year, which was around $433,000. But then you look at their operating expenses, and while there's so much more money going out than coming in, they spent over $4 million out than coming in. They spent over $4 million coming in. They spent over $4 million on operations in those 3 months and had a loss from operations of almost $13.40 they brought in. They were spending a lot more than $1. They actually saw a pretty big jump in revenue in early 2025 compared to early 2024. They say it's because more people are adopting their technology, including home fire defense systems and sales to fire departments. They split their revenue into product sales, which brought in about $604,000, a product installation services, which brought in about $36,000 to $4,000, and product installation services, which brought in about $3,600 to $4,000, and product installation services, which brought in about $64,000 in product installation services, which brought in about $364,000. It's good to see they're getting into services too. This is a really important point. Their business is super tied to wildfire seasons and weather. If there are more fires, they likely sell more, but if the weather's mild, their sales could suffer. It's like a sunscreen company that really only does well when the sun is shining brightly and often. They acknowledge that their sales are usually higher in the summer, but they saw even some sales in January 2025 due to wildfires in Los Angeles. So maybe that seasonality is changing. Here's a little nugget that caught my eye. They have a management team of 4 people, but crucially, none of their key executives are actually full-time employees. They're relying on a small group, and it's not even their full-time focus. This could definitely slow things down and make it harder to manage the company effectively. It's like having a 4-person band where several members have other full-time jobs. Now for the scary part, their own auditors have basically said there's serious doubt about whether the company can keep operating. This is called a going concern warning. It means GEV hasn't made enough money and doesn't have enough cash to cover its expenses for at least the next year. They are dependent on getting money from outside sources like investors. This is a massive red flag for any investor. Let's talk debt. They are what you call highly leveraged. That means they owe a lot of money. As of March 2025, their debt was over $6.5 million. A lot of this is from convertible notes, which are like loans that can be turned into stock later. This much debt can make it really hard for a company to grow because so much of their money has to go towards paying off those loans instead of investing in new products or marketing. The auditors highlighted that they had to do a lot of work looking at the value of GFEI's intangible assets, which are mainly patents, to make sure they were still worth what the company claims. They had to check if the company could actually make money from these patents in the future. This is important because patents are like a company's secret sauce, but if that sauce doesn't lead to sales, the patents aren't worth much. Another tricky area the auditors mentioned was the valuation of something called a derivative liability. This one's a bit technical, but it basically relates to those convertible notes they issued. Sometimes these notes have features that are so complex they have to be treated like a separate financial contract that needs constant reevaluation. GEVI uses a complicated model to figure out the value of these liabilities, and the auditors spent extra time making sure that model and the numbers it used made sense. It tells us there's a lot of guesswork and complex math involved in figuring out their true financial picture. Let's look at who owns the company. Theodore Ralston, who is a big boss there, basically controls most of the voting power through his Series A preferred stock. Even after this new stock sale, he'll still have a massive chunk of the voting power. This means he can make most of the big decisions for the company. In fact, it says he controls around 81% of the voting power. That concentration of control is something investors always need to watch. Looking at the financial statements for the full year 2024, GEV brought in about $808,000 in revenue. That's higher than the nearly $521,000 in 2023, which is a win. However, their total operating expenses were a staggering $6.1 million. That means for every dollar they made, they spent about $755. That's a huge disconnect and a major reason for that going concern warning. They had revenue of $808,000 in 2024, up from $520,000 in 2023. They attribute this growth to their product becoming more known after getting approved by the EPA and getting patents. They're selling their CitroTech product to a few key customers and also to people who are testing it out. They are also dealing with the EPA, which is a big government agency that keeps an eye on environmental products. This means GEV has to follow specific rules about what they can say about their product and how they label it. Plus, the EPA could inspect their product and even their factory. It's another layer of oversight and potential complexity they have to navigate. Remember that management team I mentioned earlier, the one where no one is a full-time employee? Well, this section really hammers that home. It states very clearly they are relying on a 4-person team who don't dedicate all their time to the company. This lack of full-time commitment from their top leaders could really hinder their progress and efficiency, making it tough to achieve their goals and potentially hurting investor returns. Let's check out their balance sheet. As of March 2025, they have about $5 million in current assets like cash and what customers owe them, but their current liabilities, what they owe in the short term, are almost $5 million too. That means they have very little cushion. Their total stockholders' equity is only about $4 million. That's a tiny buffer compared to their huge accumulated deficit of almost $87 million. Now for my take on GEVI, looking strictly at these numbers, the company is in a tough spot. They're losing a lot of money, and that going concern warning is a big red flag. The fact that their management team isn't even full-time is also a major concern. They are trying to break into a growing market with an environmentally friendly product, which is a positive story, but the execution and financial health are seriously questionable right now. The plan to get listed on Unsafe is good for visibility, but it's contingent on the stock sale and the ability to meet listing requirements, which their current financials make look very challenging. The massive amount of debt they carry and the complex financial instruments they use, like those derivative liabilities, add even more risk. It feels like they are burning through cash very quickly without a clear path to profitability in sight. Alright, that's our deep dive into general enterprise ventures. What do you think about GEVI's future? Does their green product outweigh the financial red flags? Let me know your thoughts in the comments below. If you found this breakdown helpful, please hit that like button and subscribe for more critical looks at corporate filings. And hey, join our Discord community in the description if you want to discuss these and other companies further. Thanks for tuning in to Corporate Decoder. We'll see you next time.